Daily Energy Markets live video podcast on Thursday, the 17th of November. Oil trading around $91 a barrel, well back to where it was before the Russian invasion of Ukraine. I'm joined this morning, I've got to say, we just had a little green room conversation, and it seems as though my three guests this morning have all had their minds on other things this week, apart from the oil markets. But we will struggle to get around to all, I guess. We've all been doing other enjoyable things. But let me welcome Dr. Carol Nakle, CEO of Crystal Energy, who is in Spain at the moment. Richard Rodolio, CEO of Matrix Global Holdings, who is in California, having been traveling around the US, I hear. And last, Matt Stanley, partnership leads in Middle East for Kepler here in Dubai. Although I shouldn't say last, should I, Matt? Because as an Arsenal fan, you are in fact first. You are top, aren't you?
That's right, Frank. Well picked up.
We may get round to that later, Matt. But let me kick off. I last weekend was in Sharm el Sheikh for a few days with the Saudi delegation at COP27, and had a good time, an interesting time, a fun time, but came away with the feeling, you know, what has this changed? How has this affected the world? How, you know, what I've just experienced, how will this change anything? And then I read since then that the G20 taking place over in Bali actually looks rather more determined on climate change than COP27. The G20 has come out with quite a firm pledge to, you know, to try and hit the 1.5 degree increase target. Whereas COP is still debating it. We aren't even sure that the final communique from COP will, you know, reassert this as a target. There is some pressure to drop it. So I would like to just quickly get the thoughts of all three of you on, you know, matters related to climate change. And let me go first to you, Carol. So, you know, this is obviously of crucial importance to the energy industry, how we respond to the threat of climate change. Give me your take, please, on climate change, which has been on the top of people's agenda this week.
Good morning, Frank. Good morning, everyone. Greetings from Barcelona. Well, look, I mean, I'll tell you very briefly, I don't think COP27 is receiving the same noise in the media attention and coverage and discussions as we saw with COP26 last year. You feel that the mood is more subdued this year. And this tells you, it's a reminder of how an economic crisis with high energy prices is actually the main thing that can drive people's attention and people's interest. Yes, before we had COVID, it was an economic crisis, but we were not facing the same challenges we are facing today. Today, people are worried. In Europe, they are worried about getting through winter, a cold winter. So far, we have been blessed. We have been lucky with a mild winter. So there is more on people's minds than it was, for example, last year. At the end, people are driven by what is, you know, how much pain they feel when they go to the supermarkets, how much pain they feel when they try to book a holiday for the family. And this is becoming worse and worse for families around the world. In the rich countries, you mentioned G20, but these are the rich countries. But even there, you are feeling a lot of pain, let alone in the poorer countries. So everywhere you find governments much poorer than what we saw before. And that by itself is going to negatively affect the climate change agenda. Because don't forget, we were told about climate change, about when we set those targets, we were told it's going to be a smooth walk in the park. It was going to cost very little. And all that turned out to be not true. We still need fossil fuel more than ever. What the crisis has shown is that you still need investment in oil and gas. And actually, the same people who are saying don't invest anymore, they are asking everyone today, please invest more. And that by itself is going to shape the climate change agenda or whatever pledges are going to be made at COP27. But I have to clarify one thing. There is a difference between pledges and execution. Even in the most advanced economies, the pledges that have been made are not being met because of very small hurdles, regulatory hurdles, you know, delays in getting approvals. So there's also something else we should be aware of. But I would say that today there is much bigger concern on people's minds everywhere around the world than climate change.
Yeah. Yes, exactly. Matt Stanley, you've had a tough time in Dubai this week with Bari Week, I understand, but was climate change and global warming targets, were these an item of conversation in your various meetings at Bari this week?
Look, I mean, I agree with Dr. Carroll, but in essence, it shouldn't be a surprise what's happened this year to, global energy supply. The one thing that's been on everyone's agenda is that it's highlighted the fragility, especially if you're in Europe, who rely on 1 million barrels a day of gas oil coming from Russia. How do they plug that supply? The primary concern has to be what happens with energy security now across the globe. And COP26 highlighted a few important changes, and people's agenda was different. But the overall macro picture was a lot different then. And I think it would have been naive, even for Greta Thunberg, to say, I'm expecting quite a lot to come out of COP27. It was always an event where let's maintain course, for the ultimate goals we set ourselves in Glasgow and in Paris last year. But essentially, the world still needs energy. And I think that's why we saw such a big delegation come from the UAE. I think they had 90 people who were attending. These weren't, these weren't managers sitting in the back of a trading desk. These were guys who were there and looking to leverage the position. His Excellency Al Mazroui has made it clear, even when the climate change discussions were happening in Paris and Glasgow last year, that the UAE is ready and willing to invest in fossil fuel production. Now people want the energy. France recently, or Total recently, signed an agreement with ADNOC on gas oil supply. Uniper are going to do the same on gas. We've seen that. For the GCC core, what's happened when it comes to energy security, and of course on the back of COP27, is a good thing for the GCC core, because energy prices will remain elevated. It's a good thing for people in the Middle East Gulf, the new refining sectors that are coming online in Duqm, Oman, which is going to be the end of next year, and the new refinery in Kuwait, and the Indian refiners. So there are people who are going to benefit. And I think that primarily was probably the conversation, the way it was going. Where am I going to get my energy from come post-Feb 5th, when Russian energy is boxed in the EU?
Yeah. One notable thing in Sharm el-Sheikh was that the oil industry had a much greater prominence, certainly than it did in Glasgow, and I think more than any previous COP. There's always been this feeling we don't want these, dirty, polluting hydrocarbon companies anywhere near us, but they were there in force in Sharm. And indeed, there is a feeling too, I think, that the COP27 is a bit of a holding pattern, and the COP28 next year here in the UAE, where I am, will be the one that makes big decisions on climate change.
Yeah.
But Richard Radolia, President Biden was there for a short drop-in visit. He came on with a multi-billion-dollar package of renewable and environmental measures, most of it already announced under the IRA, I must say. And he mouthed lots of environmental platitudes. But at the same time, he wants OPEC to pump more oil for the rest of us. Where's the logic?
Well, we know the logic. It doesn't hold true, that it's you can't have your cake and eat it too, is the most famous saying of all. And I think the Democrats had a really good showing in this election. It gave him room to maneuver. He feels emboldened. And he is going to continue to push for climate policies. It's happening. There's no going back. And I think that what Carol said and what Matt said was exactly right. The market had a wake-up call here in other parts of the world where prices went up. It caused a belt tightening, and people were worried. Oh my God, it's going to be a lot more expensive than I thought to have a Tesla, or not even have a Tesla, just to turn your stove on. And so I think the real problem, and it will continue to be a problem, and I've said this for a year now, and I'll continue to say it, the problem is not now, the problem is 23 through 25. It's the lack of investment that's going to occur in the oil sector, because money's being moved towards the green sector. The banks want to put it there. The hedge funds want to put it there. The money that is moving towards investment is moving into the green sector. And in all my experience in watching oil markets, whenever oil prices elevate, you tend to see a push into more production, which comes on about a year and a half later. That production tends to put pressure on oil prices, and down it goes again. We're not seeing that anymore. And so I think what happened with Biden and what he's going to continue to say, illogical as it sounds, you can produce oil, OPEC, and what Matt said was right. This is going to be a windfall for the GCC. They're going to make a lot of money in the next 4 to 5 years. And so I think what we're faced with here is a disconnect between what is oil demand going to be, or what is oil price going to be when demand gets to 103, 104 million barrels? Where are those barrels going to come from? And that's the big question. And I think we are faced with it's not going to come. The U.S. just said today we're not going to get back above our high numbers in 2019. We're going to get to around 12.3, 12.32, and then it's going to start to level off again. And we are not going to see the investment. That's it. The money's not going to flow into it. We will see. I'll talk about a statistic from a trading perspective in the next round. But I think,
Let's talk for a moment about where this extra supply might come from, because we're a couple of weeks away from what's being billed as one of the most controversial and decisive OPEC Plus meetings of all time, December the 4th. That takes place just ahead of the EU ban on Russian oil. The following day, on the 5th, the two reports this week, OPEC were predicting a small increase in demand. IEA, on the other hand, cut its demand forecast by a small amount. There has been some talk in the background bubbling around about a partial restoration of some of the cuts that took place at the last meeting, and which annoyed President Biden so much. So it's all swirling here. It's rather confused and murky. Dr. Carroll, give us your thoughts. What will happen on December the 4th?
What will happen? Well, look, I mean, of course, I heard like you that there could be some reversal of the cuts when I was in Abu Dhabi for ADIPEC last week. Even among, privately, some people in the UAE believed that going for 2 million barrels a day was too much. But of course, publicly, they have to put on a united front. But at the same time, when I look, you mentioned the demand forecast from OPEC, but if I'm not mistaken, compared to previous forecasts, actually it's much more tame. They revised downward their demand forecast, still growing, but not at the same speed or the same level. And that by itself can provide them with the support they need to justify their cuts. And at the same time, we shouldn't remember that the 2 million barrels a day do not really equate to 2 million barrels effectively taken out of the market. And that's what OPEC has been saying. They said, look, yes, we announced this cut, but the market has taken it nicely. Prices did not shoot up because there is a demand uncertainty. And I know we're focusing on the supply, but I do believe that the biggest wild card today is demand. China is the biggest wild card. I mean, we heard about a little bit of easing of the lockdown, but in my opinion, easing of the lockdown to such an extent, or COVID-related policies, means that infections are going to spread more rapidly, and that increases the likelihood of more lockdowns, even if they are short-lived. And that by itself creates certain uncertainty. And also we focus a lot, for example, on investment coming on stream. Governments around the world, and I'll be happy to cover it later, talk about they want companies to invest more, yet they go and threaten them with windfall taxes, and really oversimplifying a very complex concept. Because in the North Sea, maybe today we're going to hear further announcement from the Chancellor about higher taxes on oil companies after they introduced a few months ago, and that reached the highest level of taxes oil companies would pay on new development from the 1990s. So that's something you have to remember, that this contradiction in policies where they say bring more supplies, invest more, but you know what, we're going to squeeze everything you're making out of you. But at the same time, they go and subsidize demand. They go and tame energy prices. So this confirms, what we heard earlier from Richard, this kind of mismatch between demand and supply. So to go back to your question about the short term, what will happen in a few weeks' time, there is a good chance they might stick to what they have announced if the demand outlook, if they stick to their outlook, gloomier outlook for demand forecast. So that's in a nutshell. But things can change between now and then.
Yeah, of course. Matt, what's your take? Conscious of the fact that the following day is the EU ban on Russian oil comes into force. If there's a forecast big hit from this, isn't that the perfect excuse for OPEC to increase output on the 4th of December?
Well, there's so many ambiguities, Frank, and this is the $1 trillion question, isn't it? People are pricing in recession. I heard that in Q4. I'm not seeing a lot there. I know inflation is still high, but the market doesn't seem to be that bothered. You look at what Biden tried to do with the SPR releases. In the States, there's about 390 million barrels of storage. That's a 40-year low. So is that the leverage that he's got? It depends how you look at it as a trader. You know what? If you're Vito, the glass is always half full. If you're someone else, it's always half empty. So does that mean that the SPR needs to be replenished? Is that supportive for flat price? As Dr. Carroll says, what happens with China? Still locked down. China has always been a demand center that people have swayed towards and checked the data that's coming in on a monthly basis very carefully. Still no news, even though there's been rumors over the last few weeks. But essentially, what does it boil down to? Flat price has been stuck in a range between 85 and 100 since the end of August. And that is one reason only, and that is because no one really knows what is going to happen to supply. Do trade patterns continue to stay with India buying as much Russian oil as they can get? I don't know. I mean, Canadian oil sand producers have been doing very well. Do they step up? Brazil are certainly looking at it as well. And ADNOC announced earlier this year that their plan to produce 5 million barrels a day of crude is going to be brought forward to 2025 instead of 2030. That's a 60% increase from where they are now. If you've got the appetite, and not as many people do, which is reflected in EIA production, weekly production still 12.1 million barrels a day around there. I agree totally with what Rich is saying. It's not ever going to get back up to the 13 and a half. 2020 was too much of a bruising time for everyone in the US oil industry. And, the irony making hay while the sun shines is literally maintaining that course. And it has done for the last 3 years. I don't see that getting back up. Essentially, what we see as Kepler is we see US oil production dropping to about 9 million barrels a day by the end of Q1. Now, if that starts, that's from say 11 and a half right now. In a market that is extremely delicately balanced, Frank, 100 supply, 100 demand, more or less, that is only going to mean flat price goes one way. But the market isn't sure, because when we hit $139 a barrel in March, the market thought, oh dear, we're going to run out of Russian oil. What do? Run for the hills. Flat price got carried away. Slowly, it started trickling back into the market. But now that there is an official banning of energy in the EU, it will be scrutinized and will be enforced a lot stricter than it has been so far this year. If by January we start seeing that Russian oil production come off, then energy prices could easily get back up to the mid hundreds. Right. Okay.
Richard, the demand supply balance, you've got some thoughts on this, haven't you?
Well,
Tell us.
Yeah, I've always thought, I think that to me, the key factors is that demand is known in real time, almost, right? We don't Carol made a very good point. There's so much uncertainty, but once the demand is there, we know what demand, we know how many flights are taken every airport every day. We know what every city has, the demand is, and OPEC is able to adjust it accordingly. I think what OPEC has done, I think one of the more important statements that has been said wasn't when they cut the production. I think the Saudi minister, and maybe it's Matt and Carol can correct me if I'm wrong, but I think what they said is, we're Saudi Arabia, we're only going to 12 million barrels a day, and you guys need to get your act together and be able to bring in some more production online. I think that's what they said. And that was the first time ever where I think Saudis put a limit on their, put a ceiling on their production number. And what Matt just said, I think you said US, Matt, but I'm pretty sure you meant Russia. If Russian production falls from 11.5 to 9, and at some point it's going to have to, because there are no more valves going from Houston into the Russian oil field. There's going to be some natural declines that are going to go on there. We should have a limit. We should have a limit on how much supply we're going to see into this world. And so it goes back to Carol's comment. What is demand going to be? Is it going to fluctuate? Are we going to have a strong recession? So we are in this tremendous area of flux. It's difficult to get a handle on exactly where it's going to be. I will say, though, that the market, in my mind, is telling us where it's going to be, or it's at least telling us that there's going to be tightness. And I'll give this statistic. If you look at the 12-month spread, so let's go forward 12 months, look at Brent, the 12 to 13-month spread, 1 year forward. That spread currently is 60 cents backwardated. So DCJAN of 23-24 is 60 cents backwardated. That is the highest spread value almost in history, forgetting the spikes. Let's just talk about a levelized amount. That value, that 60 cents backwardation, is greater than the value of where it was back in between 2011 and 2013, when Brent was trading $110 to $120. Well, what does that mean? What does it mean when you have a spread 1 year forward, 60 cents backwardated, and the flat price is $30 under the price of where it was last time? It means to me that the market is worried about supply. It's worried about the market being so tight and exploding to the upside, because if something goes wrong and Russian production goes from 11 to 8, we have a problem, and there is no making it up. There's no windmills that are going to work. There's going to be not enough LNG. It's going to be a real problem. And the distillate problem we're seeing now in the States is going to be exacerbated, because all of that distance is going to be going into power generation. It's going to be a real problem. So I think it's the market's telling us in price, even though it's not the flat price, it's the shape of the curve to me that's making the biggest, is the determinant here.
Okay. Richard, I want to stay with you and quickly go around the table here for the three of you, just to get some thoughts on developments in the US over the past week or so. We've seen the results of the midterms. That's pretty clear now. We've also seen Donald Trump throw his hat in the ring again, and the emergence of DeSantis as a serious challenger to him. I'd just like to know, what this means for US energy markets and global oil markets. Rich, give me your succinct thoughts here, if you would.
I think that the election has given Biden free rein. He is going to push his climate agenda fully. It is
bad news for investment, yeah.
Bad view, Matt. There'll be the energy industry will suffer under the Biden administration, as it already has. As it relates to Trump, a good example is Rupert Murdoch, who runs the New York Post, which is our kind of daily, the flashy newspaper. The New York Post said at the bottom of its headline, "Florida man announces nomination." That's what's the term. It wasn't a Trump picture. It said Florida man announces nomination, story on page 26. I think that in a nutshell tells you what the uphill battle that Trump has. Yeah. So I don't think it's Republican, or I don't think it's Trump or DeSantis. I think it's very much, it's going to be the Democratic push is going to be towards climate change. The head of the Democratic Party in the House leadership today said that's going to be one of their number one focus, and that's where it's going to go. And I think that is the reason why the forward curve is the way it is.
Yeah, the love affair between Rupert Murdoch and Donald Trump is well and truly over, it seems to me.
Yes,
Carol,
it is.
I don't expect you to talk in detail about US politics, but what do these various scenarios mean for energy markets?
Well, I know I have to admit I'm not a big fan of US politics, but US policies are a little bit different, and they're actually very interesting with great implications on global energy markets. But one thing comes to my mind as I was listening to Richard. Now that Biden has felt empowered, and then he maintains majority, he maintained the position that was at the beginning, before the elections, everybody was worried about. One question arises that, is he going to soften his stance on, for example, the release of SPR or prices at the pump? Because if you look at a statement published by the White House just a few weeks before the midterm elections, they called it Putin's price hike at the pump. So they really politicized the topic, putting all the blame on Russia, which I think is, again, too simplistic. Of course, they played a role, but they are not the major driver. But I wonder, now that the elections are gone and Biden has a margin of 2 years, or maybe a year before started to worry again about what happens for the presidential election, does this mean we're going to see a softened stance of the US vis-a-vis oil prices prices, global oil prices. So they are going to rethink the use of SPR. So we're not going to see the same feverish, excited statements and announcements about the use of SPR, about OPEC. So that for me would be the interesting thing to watch in US politics. And at the same time, I'm not expecting them to show any more lenient stance on the oil industry. They have, mentioned the idea of windfall tax, but what people don't realize is that in the US, the tax system on oil companies is already much more complicated than elsewhere. It's pretty regressive to a certain extent. So that by itself will be shaped by what we're going to see coming from the White House in the coming months.
Right. Matt, how do you read all this, the US map?
I want to thank Richard. Yeah, I did mean Russian oil production, mate. It's been a long week. It's not over yet. So thanks for picking it up and clarifying. Look, I mean, I was in Miami at the end of October for a fuel oil conference, and in an Uber or in a taxi, the best economic indicator to ask anyone is ask a taxi driver. Are you busy? What's going on? They usually moan about oil prices. They're still moaning about oil prices, Frank. And for me, this is a recessionary issue as well. This compounds to all the ambiguity we've been talking about. Gasoline refining margins since May have collapsed. And that's given Biden a favor because the recession is helping him because the gasoline market is assuming that demand is going to fall away and gasoline refining margins have collapsed. That means the price at the pump is that much lower. And even though flat price on crude hasn't really moved, people aren't looking at that as an indicator. He's using that as leverage. He used the SPR as leverage. Gasoline cracks have really weakened in the last few months, and that has helped Biden. And I said this at the start of the session, if recession is priced out somehow, inflation starts coming off. We started to see that last week, really. People coming out the dollar into riskier assets. Do they start doing that again on gasoline margins? What effect does that have on, he's very well supported at the moment. And as Richard said, it gives him, carte blanche to effectively go ahead with his current policies. But the market is very fickle. And the electorate are very fickle as well. If suddenly gasoline prices spike in a month because the talk isn't about recession, it's about recovery and continued recovery, and people are back paying $5 at the pump again, it's a different dynamic. And if he hasn't thought of a way to mitigate that, well, I'll leave my thoughts to myself. Yeah.
Right. Okay. Can I pull up the poll question, please? Because we are back to environmental climate change matters on this. So if you could have some thoughts about this. The target of keeping global warming to the 1.5 degrees suggested in the Paris agreements is now impossible to meet, and international policymakers should abandon this and prepare for the worst. Do you agree or disagree? There might be some other option in between, but it was too late to think about it, and all those options seem rather vague anyway. So let's just have a straightforward vote on where we think the 1.5 target is likely to go. So vote on that, please. And for the few minutes remaining, I want to talk about something which is not directly connected to energy markets, but which has been an incredible story for the past couple of weeks, the downfall of FTX, the cryptocurrency exchange which has gone bust effectively, losing billions. Its founder also became an instant pauper overnight. And there was a really interesting event here yesterday, rather down the road in Abu Dhabi, where Nouriel Roubini was on stage, and he absolutely slammed the crypto industry, and in particular Changpeng Zhao, CZ, the head of Binance, the biggest crypto market. He said he was a walking time bomb. But I think it's really interesting to get the views of people like you, who are obviously financially smart. What do you think of crypto, Richard? You're in the.
I've been in that space. I worked on Wall Street for 20 odd years, right in the middle of it.
Is it a time bomb?
Excuse me.
Is it a time bomb?
I think it could be a time. Well, it's a time bomb for the $16 billion that was just lost. It was. I think that CZ probably is right. You know, I'm not sure if you're aware of this, but FTX was after George Soros was the second largest party. He gave $40 million. He had the head of the ex-head of the to the Democrats. He gave the ex-head of the CFTC was working for him. You know, it's a very, very ugly story that's been put there, and I'd recommend taking some look at just the amount. He needs to go to jail. There's no two ways about it. He had a backdoor. Seems like he had a backdoor into it. I think that there's useful reasons for blockchain. I played it back from 2016 and got out near the high, so I'm kind of happy and paid for some things. But I think that I don't trust I played Ethereum and all these different ones. I think Ethereum and Bitcoin, there's a couple. All these other coins are probably lost. You know, it's called I think hypothecation was going on. What they were creating their own value. They created their own token. They created and then took the price up and then borrowed against the gains of their own token against a bank that it created. It's Bernie Madoff. You know, these things are unregulated, and the problem is I'm not sure I trust our regulators to get it right. And so we'll find out. You know, we're going to find out. I'll leave it to the rest.
Carol, what do you think of crypto? And I mean, very briefly, is it something that will seriously affect the rest of financial markets and indeed the economy, the global economy?
No, very briefly, it's a sector, an industry that is moving much faster. The regulation is by far much less regulated than perhaps other less dangerous, I would say, or relevant industries. So I think it's not about, you know, killing that sector or not, but it's more about finding the right framework so that sector flourishes without having these kind of stories becoming the norm.
Right. Matt, as an Arsenal fan, you like esoteric, complex things that have a tendency to collapse suddenly, don't you? What do you make?
I stayed muted there on purpose, Frank.
Of course I did. The whole segment was designed for that question.
Yeah, exactly. Yeah. No, look, I mean, I agree with you. Blockchain is going to be something that will be important for the future of global commerce. We're working on a few bits internally. Effectively, what we do is a form of blockchain when it comes to technology. But Bitcoin and Ethereum, you know, I'd sell them quicker than I would Harry Kane, Frank. So
you had to get one in at the end. Okay. Well, look, thank you, guys. That was fun. Carol, Richard, Matt.
Thank you, guys.
Have an easier week next week, and I hope to see you again then. Thank you all very much.
Cheers.
Thanks, everybody.